definitely stimulated the economy, but it overstimulated. It's like giving a 2-year-old sugar.
Too soon, too fast.
Yeah. And I'm like, good morning, everybody. Jesse Paul here. Welcome to the Real Estate Morning Drive. This morning, I've got Chantry Abbott with Guild Mortgage. And the question I had today was, are interest rates actually going to go down in 2025? The big question everybody has.
What's going to happen with rates? I'm going to wait for them to go down, all that stuff.
And I have a lot of people that are not necessarily asking that question, but just on the fence. Like, man, we're just going to wait and see what happens.
Yeah.
And, looking at it from the real estate point of view, you can never tell the future, right? And you can never 100% be correct. But my concern about that is you are hoping the market goes down. Well, people did that last year. They were waiting for two things. Number one, they were waiting for the market to go down. And number two, they were waiting for interest rates to go down. Neither of which happened, right? The market in southern Utah actually went up by about 3%. And interest rates, although they dropped for a minute, what was interesting to me, as soon as the last time the Fed dropped the Fed rate, interest rates shot up about 0.75 of a point and then stayed. I'm a little bit hesitant myself to go, okay, I'm just going to wait.
Sure.
Because the people that waited last year now really just shot themselves in the foot.
Right.
Right.
Most of the people we're talking about, here's I think the big mistake is that we're not talking about people that are buying properties and selling short term and what I call day trading real estate. That's not like what most of the people we're talking about. What we're talking about is people that need a home that fits their family's needs, that they plan on being in for a while.
Right.
Several, 5+ years kind of a thing. Mm-hmm. And if we go out far enough, while we can't exactly predict what's going to happen, I can pretty confidently say 5-10 years from now, especially 10 years from now, there is no doubt that the value of real estate will be more than it is today.
Well, when you look at any 10-year period over the last 40 years, there has never been a time in southern Utah that the values were not higher,
right, than
they were 10 years ago.
Right.
So that's a very fair assessment.
Right. And I tell this story all the time, so I apologize if some of you guys have heard it, but I bought a house in December of 2007, my very first house. What was the market like in December of 2007? The market was the hottest, highest, stupidest it's ever been. So I pay $154,000 for this townhome. Fast forward a couple years later, and what do you think that townhome was worth, Jesse, after the market crash? So I bought it in the end of 2007, 2010, 2 years later. What do you think that house was worth? I paid $154,000.
$75,000.
Pretty close to that, yep. 80, 90 at best. But could I have even got somebody to buy it? There were so many homes that immediately went into foreclosure that could you have even got attention on your house and get it sold, even if you were at the bottom of the market?
Yeah.
Because there was like 8 or 9 times as many properties available for sale as there are today. Yeah. I think the number hit like 2,500. That's a lot for, and especially back then that was a lot. Our market, that's what I mean. I would dare say our population is not quite doubled, but pretty since close. 2007 almost pretty close. Mm-hmm.
So that is a lot of homes for sale
for that many people
for that time.
And that was really a little bit before St. George had got super popular with like the short-term things and stuff. So I just don't feel like the market's really shifted here, and I feel like it's grown a ton and gotten a lot more popularity as far as people wanting to be in real estate here, that even if they don't live here. Yeah. So anyway, long story short, I still own that townhome.
Okay.
So it's an older.
Now let's talk about what it did. So it dropped to $75,000. You lost half the value. You held on.
Yep.
Right? It was a rental the whole time, so it always cash flowed for you, or at least broke even.
We lived in it for the first 3 years.
Okay.
That's really why we bought it. We were going to just rent a place.
Okay.
But I just got together with my wife. She had a little dog. We went and looked at 3 or 4 rentals. we were in our early 20s and had a dog, and no one was accepting our application. And the ones that would, the places weren't something we would even want to live in.
Yeah.
And so we had a friend tell us, hey, maybe you could buy a house. And we're like going to school and stuff. I don't I don't think we're quite there yet, And she's like, well, just go meet with somebody and see if you can.
Yeah.
So sure as crap, we got approved for 100% financing.
Uh-huh.
Went and looked at 3 homes, bought one.
Yeah.
Didn't know what we were doing, but we were excited. We loved the house. We loved the townhome. It was exactly what we wanted. Put a little work into it, some tiles, some paint, nothing major, just as we lived in it. And then 2011 hits, and I'm in mortgages now, starting to make a little bit of money. My wife's graduated college, so she's starting to make a little bit of money. And we're ready for a single-family home, little yard.
Yeah.
We know we got some kids are going to be coming soon. We want to be ready for it. So 2011, 2012, we go buy a little single-family house over in Shadow Mountain for $200,000.
Yep.
Fast forward to today, we still own the townhome. We owe like $50,000 on it.
Nice.
And I'd love to have paid it off, but with rates gone down, I've got like a less than 3% mortgage on it. So it's like,
that's hard to pay off, isn't it?
It's basically free money. So, but when we moved out in 11, our rent still covered our house payment. So that's kind of one really interesting thing is when the real estate market crashed in 2010, 11, rents actually kind of went up because there was a lot of people that couldn't buy anymore.
There was a lot of people that weren't buying that would have been that are renting. Yeah.
So,
that makes sense.
So we ended up renting it to at least cover our $1,100 house payment.
Okay.
Still have it today. The rent's $1,700. Oh, let's call it 50. And what do you think that's worth? 3-bed, 2-bath, no garage, a little bit older.
Probably 300.
So 300, we'll say
320. Yep.
So it's worth in the 300 range. So it's doubled since the peak, and it's tripled since the bottom.
Yeah.
And so I just always tell that story because I say I bought it the absolute wrong time.
Yeah.
But it just didn't matter in the long run. It just didn't matter.
That's true.
And so for
That's
people that want to like predict the market and day trade, here's the honest truth. No one knows what's going to happen. It's a guess. What you've got to do is just buy a house when it makes sense for you. Like if you're about to change jobs, or you might not see a future here in Southern Utah, or you may have to relocate for some reason. Like I just met with a medical student, and he's almost done with his whatever degree, and he really wants to raise his family. As soon as he's done, him and his wife want to start having kids and raise their family here in Southern Utah.
Okay.
So they sit with me about 6 months ago, and they're like, I think we're ready to buy a house because he's working and going to school, and they really could qualify. But there was this underlying thing that in 6 months, like so coming up in May, when he's done, he may have to go take residency somewhere else.
Yeah.
And so I actually kind of help them talk themselves out of doing it.
Yeah, because it doesn't always make sense.
It doesn't.
If I've been saying for actually a couple of years now, if it's not at least a 5 or 10 year decision, it's probably not a good one.
It might not be because there'd just be too much risk and pressure.
Because you're speculating.
Uh-huh.
You are too dependent on what happens to the market.
Yep.
If you're less than 5 years. Now, if you're 10 years, you're not as much dependent on anything except for the rhythm of real estate, right?
Just the rhythm of life, right? The true inflation of everything.
But
cars are going to cost more in 10 years than they did today. It's not like real estate is this unique thing that's just going to forever go up. It matches everything.
It ebbs and flows, right?
And it's going to match inflation.
Right.
Which the government wants, 3% inflation a year. So you times that over a 10-year period, that's a lot of growth.
Right. So let's talk about, you and I were talking before the show about what you thought, and I've, not that I know anything about this, but I've been saying for a while, you cannot artificially control anything without severe consequences long term.
Absolutely.
Right? So for 15 years, the Fed was controlling mortgage rates.
Yep.
And they were doing that by buying mortgage-backed securities, right? They were basically buying the bonds that control the interest rate. Am I understanding that correctly?
You are. Yeah. So they were buying billions of dollars of those in order to keep sort of a high demand.
Right.
The high demand means they're gobbling a lot of them up, so all these other investors are getting the rest of them when there might not have been as much need. And it drove the prices of mortgages down the rate of mortgages. And they did that on purpose.
Right.
In order to try to keep the real estate market afloat. Because we were
after the Great Recession.
After the Great Recession.
Or during the Great Recession. Yep. And what happened is then when they should have stopped, they didn't. They were afraid to take their foot off the gas in fear of what would happen.
Yeah, realistically, they probably should have stopped in like 13 or 14 and started easing it back. And they always talked about it, and they had this buzzword, it's called quantitative easing.
Yeah.
Really what that meant was they were going to slowly stop buying as many, and then eventually they were going to not buy any, and then eventually they were going to sell some of theirs. But out of fear of what that could do, because what if, we're experiencing it now. They were afraid, what if rates go to 1985 levels if we immediately back out of the market and they're at 18%? What's that going to mean to real estate? And when we talk about real estate, you think about how many careers and professions and businesses are impacted by building a home. Think of all the subcontractors. Think of all the material providers. Think of the laborers.
Yep.
Think of the real estate agents, the mortgage guys, the insurance agents,
people.
the title company. It's like real estate drives our economy.
Yeah.
And so they were just really afraid to have any sort of a knee-jerk reaction and go the wrong way.
Right.
Plus, probably it doesn't look good if you're in administration and you pull that back and the economy kind of tanks.
Yeah.
Even if it was the right decision, do you really want to be the one that rips off that Band-Aid and have that be on your name? Probably not. You know what I mean?
So, and when they finally did, it's because they had to, because it was just out of control, right? The values got out of control. Then COVID happened. The price of everything got out of control.
Yeah.
Because
the honest truth is, I think the government panicked and overreacted 10 times what they should have during COVID.
Yeah.
They didn't even really give anything time to figure itself out. It was immediately interest rates went from 5 to 2.
Yeah.
Well, that matters to real estate, but it matters to everything. It matters to buying cars and boats and travel trailers and homes and businesses expanding.
Yeah.
And borrowing money and hiring more people and buying a new warehouse and increasing inventory.
Yeah. So it definitely stimulated the economy, but it overstimulated. It's like giving a 2-year-old sugar.
Too soon, too fast.
Yeah. And too much sugar.
Way too much.
There's going to be consequences, right?
Yep. And so basically in a bit of a panic mode, again, they're like, oh my gosh, inflation has got out of control. People on fixed incomes aren't going to survive because major inflation is a really big problem to our economy. Yeah. And they had to immediately get rates up to reduce people's borrowing, reduce businesses' borrowing and consumer spending in order to slow inflation. And so here we are today, let's call it 7% in rate. Since Fannie Mae has been a thing, the average interest rate, I think it's around 80 years. Somebody'd have to look that up exactly, but it's around 80 years that mortgages as we know them today kind of existed about 80 years ago, something like that. And the average interest rate over that time period is 8%.
Yep.
And so we're sitting here at 7 today going, well, I'm going to wait for rates to come down. It's like, well, could they? Could they come down? Yes, absolutely. They could come down.
7.73. So you were right. From 1971 to 2025, the average has been 7.73.
Yeah. So 55, 56 years.
Yep.
7.73. Now we had times of 18% in the 80s and we had times of 2% in the COVID, but the average is 7.75. And my whole career, even with the government's involvement. So I got in the mortgage business in 2009, right at the wrong time. I actually remember watching implodometers of banks crashing.
Yeah.
Interest rates have been between 5 and 6.5%.
Yeah. So I was I was at my physical therapist's office yesterday, and he was telling me he bought his house in, I want to say 2013. Got a great deal.
Great time, yeah.
Great time. And then his payment was like $1,100. And his dad was telling him his first house was in the 80s. And his mortgage in the 80s was more expensive than his.
Wow.
Right?
Because it was 18%.
Because it was 18%. And people were just going, okay, let's figure this out. because you have to live somewhere.
Correct.
And unless you already own a house, you're paying somebody's mortgage.
Yes.
So let's talk about, because, we started this show with, our interest rates going to go down. And we saw when the Fed, because everybody's like, oh, they're going to lower the rates. But we don't realize that when they do that, it doesn't directly affect mortgages. We saw that last time when they went up and they actually lowered the rate.
Yeah. So really what happens is when the Fed comes out and says they're most likely going to lower rate, mortgages immediately the next day change.
Right.
And then it takes a month for them to actually decide if they're going to lower them or not. So usually by the time it happens, it's a non-event. So, so just to be clear, the Federal Reserve, the Fed, the government, they don't directly control mortgage rates. That's really free economy. That's people buying mortgage-backed securities. That's a supply and demand thing of the general public. Now, where they can intersect is if they're buying the mortgage-backed securities like they were.
So that's the caveat. The only way we're going to be able to know definitely they're going down is if they start announcing again that they are going to control it one more time.
Yes.
And buy those. And they've, correct me if I'm wrong, but have they ever done that in the past where they bought the mortgage-backed securities to control that?
Not that I know of, other than the
so
one time.
That one time starting in 2008 or 2009, and then they stopped and pretty much sold them off in 2022.
Yep.
So we're stuck with now whatever the market's going to do.
Right. What's the reality of free market without government money? Yep. What they can control. So what people hear is that the Federal Reserve came in and lowered the rate. What that does is it reduces the prime rate. So prime rate is not a mortgage rate. Prime rate is a rate, in short, it's the cost banks pay to borrow money. And they're targeting a rate, a Fed rate of around 5%. And then banks got to make a little bit of a spread on that. So now the prime rate is 7.5.
Okay.
It was 8.5, I think. That directly impacts home equity lines of credit, business loans, auto loans, boat loans,
basically
RV
short-term
loans,
or consumer-based
loans, everything really but real estate. So they can't directly reduce mortgage rates by reducing that Fed rate, but it does follow a little bit. If those go down, pretty good chance mortgage rates might go down a little bit, but at the last Fed meeting, they actually said that they just don't know if they're going to lower it. Because here's the truth. The economy's just actually in a pretty good spot.
Yeah, it's still going. So is there actually really a need to lower it if the economy's staying strong?
No.
Right?
So here's when you lower it. You lower it when we aren't having any inflation or we're having deflation. So when that happens, you lower rates, increase spending. We're not seeing that yet. We're still kind of running at the 3, 4, 5% inflation. And they really don't want it any higher than that.
Right.
And they might even want it a slight less than that, to be honest. And so I just don't see.
Which is probably why they're not talking about lowering it, because they probably want that to back up a little bit. If you lower it, it's going to move forward. It's going to speed up. It's going to stimulate the economy.
Right.
And that's what we're trying to avoid is the economy getting better and better and better, or not necessarily better, but more intensity,
more activity.
Yeah.
Selfishly as a mortgage guy, would I love rates to be 5% tomorrow? Gosh, I'd be as busy as I could ever be, and I would have more business coming in than we knew how to handle. We'd have to turn people away probably. But the other side of that is if that happened, if rates go from, we're going to just say 7 today to 5, what would that do to home values in the real estate market?
They'd probably jumpstart again.
Yeah.
Honestly, because people are waiting for that. And we've been 2 years now in the 6s, over 6.
Correct.
And half of that over 7.
Correct.
So if we were to get back into the 5s, I really believe we'd have another really hot market.
And to be honest, that would be great for me and you in the short term in our industry.
Yeah, but it wouldn't be great
in the long term. It would not be good.
So now what's already overvalued, so to speak. And when I say overvalued, I mean for the local economy. So for the median income, we are 25% overvalued.
Yeah.
At the current interest rates, people just can't. What is that a family has to make to buy a $600,000 home right now? 120.
Probably 120. So the median income's just under 100. It's 9. I think it's about 90.
Household, right?
Household.
Yep.
So the median household income is about 90. So theoretically, that should buy the median home price.
Right.
So as long as you have good credit and you've controlled your finances and you're doing a good job, if you earn median income, your median income should theoretically be able to buy the median home price. What's the median home price?
About 550. 600.
So
let me pull it up real quick.
So he's
I think
saying
it's like 550.
550 range. 90 grand in income isn't quite enough to buy 550. 90 grand in income is probably more like 4 to 450.
Mm-hmm.
And so we've got that spread there already. So we just know that we've got a 20% spread between median income and median home price. And so if that goes up at all anymore, it's just going to cause even more problems. Now, St. George.
542.
Awesome. So 542 median home price. And again, the median income just doesn't buy that. You could maybe if you have no debt, but like in general, if your median income, you probably need to be at like under 3,000 in house payment around there. And that's like 400 unless you have a big down payment or something, right? We're assuming like a low down payment or something.
Right.
So we're 20% away or 100 grand away. So, man, if the market moved up another 10% or 5%, that would only increase that gap. And you know what? It's not like, I don't know about you guys, but like at Guild, I'm the branch manager. I'm responsible for 20 people in our little area. I can't afford to give them a 10, 20% raise in their income to match homes prices. I would be out of business. I'd love to.
Right. So now we're circling all the way back. If the market continues to go up, so this last year, we didn't expect it to go up. We fully expected in Washington County that we would go down a little bit more. So from 2022, we got about 2 minutes from 2022 to 2023, right? Or to 2020, the beginning of 2024, we dropped about 15%.
From the very peak,
From
basically.
the very peak, right?
And you know what? The thing to tell people about the very peak is it was going up so fast.
It was just crazy.
It always goes a little too far before it corrects.
In 2021, in southern Utah, our values raised 20%.
Yeah, and that's just crazy.
That's just, you cannot sustain
Not
that.
sustainable.
Okay, so then this last year, when we thought we'd see another 5%, it actually went up 3%. So if that continues, and let's say it goes up another 3%, and interest rates don't change or they go up, or even if they drop a little bit, it's a wash.
Yeah.
Or you've hurt yourself.
Yeah. By waiting.
Yeah. So that's a tough one for really anybody trying to figure out, man, what should I do? Can I actually read the market?
Yeah.
Right? I don't think we can, because we don't really know what happened until 90 days later.
Correct.
Right? I don't know that the market went up till I actually go, oh, wow. So Chantry, we got about 60 seconds left. If somebody wants to talk about, no pressure, no expectation conversation, how do we get a hold of you?
Google Chantry Abbott at Guild Mortgage, or I'm going to give you my cell, 435-979-1775, 435-979-1775. That is my cell phone. Text me, call me.
Gotcha.
Anytime.
And I'll promise you, when you talk to Chantry's team, there is no pressure. He's going to help you figure out what's best for you and your family.
Absolutely. And again, if it's not the right time for you to buy, we're going to help you make that decision.
Right.
It's definitely not like sell. It's like, it might not make sense.
Yep. And if you want to talk to the Larkin Group, just go on Google and Google the Larkin Group, and we would love to chat.
Awesome.
Thanks for having us, guys. Over and out.
Peace out.